to cover some of the aspects of double tax treaties for financial services. And then I've got my two colleagues sitting with me, Nirav and Nils, who are going to cover partly ESR and VAT as well. So you can see the agenda in front of you. Jack will be kicking off with an update on the UAE regulatory landscape and some distinctions which are sometimes forgotten between what constitutes an offshore and an onshore jurisdiction. In the second part of the presentation, we'll be covering a hot topic, the economic substance regulations, given the fact that the filing deadlines will be coming up very soon. The portal that the Ministry of Finance will make available to businesses should open in the first week of December. And we've already been preparing a large number of clients to help them understand the legislation and assess the impact for them. In the third part, Nico, who's got extensive expertise in CRS, we'll be covering some of the new penalties under the amended CRS legislation and how to practically handle this from the perspective of banks and financial institutions. And then in the last part of the presentation, we'll be covering both VAT and CIT. VAT, a change which perhaps is not that new anymore because the amendment to the law took place in June. But let's say that there's continuous new insights in terms of how to apply it. And then we'll finally close off with some considerations from Roberto around the application of double tax treaties for financial services and also for new types of instruments. So we'll be with you as from now on 10:30 until around 11:30, 11:40, depending on how enthusiastic our speakers become when they're covering their topics. At the end of the presentation as well, we'll have a Q&A. So the chat box is currently disabled for all of you. Save your questions until last. We will then open the chat box and we'll be happy to take any questions. If you've got any technical difficulties, please contact Ms. Lovely. For our speakers, you can simply navigate from one slide to the other by clicking on the next slide on your right-hand side. So thank you again for all of you joining for this very targeted type of webinar. And I'll leave the floor to Jack right now.
Thank you, Thomas, and good morning, everybody. As Thomas said, I'm Jack Hardan from Clifford. I'm a counsellor in our corporate team, and I lead our financial regulatory practice in the region. I've been asked to provide an overview on the UAE regulatory landscape for financial services and give a refresher on some of the free zone issues that one faces here, given the large number of those free zones and the interrelation between them and onshore business, which is becoming more blurred and relevant for discussion on matters such as how to comply with economic substance. This will be focused towards financial service regulations, but if you do have any other regulatory queries in other areas, do put those, do keep a note of those ready for the chat at the end, and we can address them later. So firstly, on the free zones, we have around 40 free zones in the UAE, and they're all a bit different. The most significant from a legal and regulatory perspective are the DIFC and ADGM, and the DIFC and ADGM differ from other free zones because they are financial free zones and they are constitutionally separated from the rest of the country under federal law as a matter of commercial and civil laws, which is still quite unique in the world. And for many years now that has broadly worked for the DIFC and continues to work for the ADGM in a slightly different way. But the remaining free zones outside the DIFC and ADGM who have less sovereignty over their laws tend to have a patchwork of some published and some unpublished legislation or codes of practice in terms of what laws apply in those free zones and where UA law applies. And there are several grey areas in that, depending on the free zone. But there are commonalities for every free zone in the UAE. There's generally a law, typically specific to the Emirates in which the free zone is, which prescribes that each free zone has its own commercial licensing laws to allow its 100% foreign ownership. And generally, there are other licensing and operating procedure rules which will apply to what you can and can't do in those free zones. After that, things can get a little less clear, and it's often necessary to engage with each free zone to understand what laws apply in the zone. Some of the more established free zones outside the DIFC and ADGM have a broader base of laws which have been created and do apply to the exclusion of UAE law in the free zone. And that's up to the DDA free zones, DMCC and JAFTA, amongst others. And there's generally in those zones specific company laws and employment law regimes that are different to the rest of the UAE. However, all the free zones, including the AGM and DIFC, need to apply the economic substance regulations and report on beneficial ownership, and that's the big thing that's, I think, changed across the region. That commonality of baseline oversight in respect to the economic substance and beneficial interest reporting is universal across the jurisdiction, even though we are seeing some time taken to roll out specific rules in each free zones. And of course, tax is always applied through there, unless it's in respect of a designated zone matter for VAT, which I think Thomas and others will talk about later. I think the most relevant for this session is to clarify is that UAE anti-money laundering and anti-sanctions compliance requirements apply throughout the UAE as a federal and penal code matter, and that's including the DIFC and the ADGM. And so there are consistent rules across the region. There are some additional implementing rules to comply for financial services business for AML, obviously, but it's important to remember that wherever you are, the same underlying federal AML law will apply to you. For financial regulations, there is a difference in terms of the financial regulators. The DIFC and ADGM have their own, and then there's the central bank and the FCA and the insurance authority for the UAE, which we'll get onto shortly. In terms of when you're in a free zone and doing business outside the free zone, having established what these free zones are, in most free zones you can't operate outside. You can't conduct commercial activity outside the free zone in which you're licensed. And we know that the DDA is, I think, is a Divided Vanhassel authority, has 11 or 12 free zones under its purview, and you can conduct business in each of those once you're regulated in one. So that's one exemption. But outside of those free zones, there is a general tolerated practice, of course, on top of the fact that you're not supposed to conduct commercial activities outside there. General limited activities in the UAE generally tolerated to some extent, but that is always a bit unclear. So you have to be very careful in how you draw that line. But any significant activity outside those free zones should be licensed by the economic departments in the relevant emirates. And dual licensing of free zone and onshore businesses has become more and more frequent but it's not that dual licensing regime is not applicable for financial services at the present time. But things are becoming a bit more blurred. We obviously have the 100% foreign ownership limits that have been put in place and lifted for entities on the positive list. That does not include financial services as of yet. So whilst 100% foreign ownership is being permitted more and more outside the free zones, it is not currently available for financial services. I think the last point just to note on the difference between free zones and other entities is that if you're in the DIFC and ADGM, there's an additional restriction on your ability to do business, and that is that you can't do business in dirhams. And that essentially means you can't open deposits in dirhams if you're a bank. If you're a currency exchange house, you can't exchange currency in and out of dirhams in the DIFC or in GEM, and you can't lend in dirhams in the DIFC. The laws are slightly different between the DIFC and AGM, but the idea here is to preserve the UAE banking market and preserve dirham liquidity outside the free zones. So that's just another restriction to be aware of. So that's covered sort of the difference, I think, between the UAE and the free zones and how the free zones operate. Now, in terms of financial services regulation, the UAE regulators outside the DIFC and ADGM are currently, and soon to be two, but are currently three regulators. The Securities and Commodities Authority, which covers securities business, and really has the remit now for almost all types of investment business of any kind, and has been growing generally in its remit of late. So most banking entities are also licensed now by the Securities and Commodities Authority for the aspects of their business which touch investment business, and that's becoming more and more the norm now as a central bank. Is really more of a traditional regulator. If we could just stay on the previous slide, actually. So that's the Securities and Commodities Authority. The central bank, as mentioned, is more banking business focused. Its payments regime has recently been heavily upgraded, so it is growing in its remit in terms of areas such as payments and financial stability in other areas, but is a traditional banking and lending regulator. The Insurance Authority has recently been merged with the central bank, which is an interesting news item. It was always thought that was going to be the Securities and Commodities Authority that the Insurance Authority would merge with, and until recently, the published directives on that were in regard to a merger with the SCA, but quite recently we found out that the central bank and the Insurance Authority have been decreed to merge by the federal authorities, and that's currently under the process of implementation. We understand that we haven't seen any implementing laws yet for that. So at the present time, the Insurance Authority is still a separate regulator, and obviously regulates all onshore insurance business and all underwriting of risks in the UAE outside the free zones. You can reinsure risks into the free zones, so you can, a free zone entity can act as a reinsurer for a UAE risk, but all UAE risks need to be written by a UAE regulated insurer under the purview of the Insurance Authority. In terms of just to complete the regulatory landscape, two other items for the financial services business, the data protection regime continues to be enhanced through implementing regulations for each type of regulated business. Most regulators in the UAE have specific directives being considered that cover data protection with data localization, increasing in scope and being required by most of government financial services entities, and that is only growing in scope, and we do expect an increased focus on local data localization amongst sort of regulated entities, and the central bank continues to include that in regulations as and when they're published. But we still don't have a broad federal data protection law. That is still in progress, we understand, and is being considered with the TRA and other regulators to sort of have a pan UAE data protection regime. So we still wait to see what the exact scope that will cover, whether it will go to the extent of a GDPR type regime or not. That seems unlikely given the compliance constraints that might put on the region, but we probably might see something broadly similar. The DIFC does have a GDPR equivalent data protection regime. The ADGM's rules are not too different. So if you're moving data in and out of the UAE into the DIFC and other free zones, you will have a different data protection regime to take into account, and you may need to get separate filings with the local regulators in terms of how you use your data, depending on which jurisdiction you're doing that in. So the last point just to mention here is in respect of AML, and as I mentioned, it is critical that wherever you are in the UAE, anti-money laundering, counter-terrorist financing, along with sanctions compliance, is assessed, and whatever type of business you are in the financial sector, you will generally need to comply with this regime, and its rules are set out in the cabinet resolutions implementing the AML law in the UAE. And generally, you need to have compliance systems which will comply with that law, plus the additional regulations which you are subject to, depending on who you are regulated by. So the central bank has its own guidance, the DIFC and ADGM have separate guidance which sort of gold plate the UAE law to some extent, and other regulators are following suit in that light. And who to in the free zones other than the DIFC and ADGM, there is and for non-financial services entities, there is some uncertainty in terms of who you make various AML filings to, but nonetheless a compliance system needs to be in place if that AML law applies to you. Just before we move on to cross-border business, and I'll hand back over to the team, in the financial free zones, we talked about who the regulators were in the UAE, but financial free zones, you have a commercial licensing authority. In the DIFC, that's the DIFC authority, which hands out commercial licenses, and who you do your corporate filings and UBO filings and economic substance filings to, and a separate regulator, the DFSA, which regulates financial services businesses and has a specific licensing regime for financial services, which is on top of the DIFC authority's licensing regime. So the DFSA's rulebook applies to all financial services business in the DIFC, but does not apply outside the DIFC. And it's the same for the ADGM. We have a registration authority that covers commercial licensing, and then the FSRA will regulate the financial services business. So before I wrap up, having spoken about how there is a restriction on cross-border business in the financial free zones and how they need to comply with financial services regulations, there are exemptions for financial promotions that are made to specific investors in the UAE and financial services clients from the free zones, and these are set out in this slide. And depending on whether you're doing investment business or banking business, you'll have to comply with the FCA's financial promotions regime or the UAE central bank promotions regime. So this is where you're in a free zone and you wish to issue financial promotions to investors outside the free zone. You need to comply with either get a local license, use a locally licensed promoter, or comply with one of these exemptions set out on this slide. And I've noted here who a qualified investor would need to be in order to avail of that exemption. For central bank regulated activities, we're still to see the central bank's equivalent exemptions for cross-border promotions from the free zones. We expect they should hopefully be in line with these to be consistent within the market, but we really don't know yet. So there's an air of caution needed in respect to cross-border promotion of banking business outside the free zones. Okay, that's all I'll cover for now. I know we're short on time, but if you had any questions on what I just mentioned on the regulatory landscape, do say those to the end, and we can pick those up after the other speakers have done their part. Thank you.
Thank you very much, Jack, for this very interesting update on the regulatory landscape. My name is Nils Vanhassel. I'm a counsel at Aurifer. And as we move on to the next part of our webinar, we'll have a closer look at the economic substance regulations in the UAE, specifically with respect to the financial sector. So as most of you will know, the UAE introduced ESR last year in March 2019, and it did so mainly for two reasons. The first one is that the UAE is part of the so-called inclusive framework, and members of the inclusive framework are committed to implementing the BEPS minimum standards. One of those minimum standards is Action 5, and that action point foresees in the implementation of economic substance requirements in low or only nominal income tax jurisdictions, which the UAE is, of course. So the first reason was its international commitments in terms of being a member of the inclusive framework. The second reason is that at the time, the European Union has put the UAE on the list of so-called non-cooperative tax jurisdictions. And in order to be removed from that list, the UAE was required to implement substance requirements. Now, in August, a few months ago, the UAE came out with new legislation in terms of ESR. So there were two legislative pieces. We have a cabinet resolution and a ministerial decision, which at the time repealed and replaced the initial ESR. Now, what is the purpose of economic substance requirements? ESR aims to target the artificial shifting of highly mobile activities, especially to low or only nominal tax jurisdictions. Having ESR does not mean that you cannot carry out those type of relevant activities in a new jurisdiction, but it means that if you decide to do so, you need to be able to demonstrate that you have sufficient substance. Now, going forward, we are going to have a look at the changes between the old and the new ESR, and then also we'll have a detailed look at the specific challenges that actors in the financial sector may face when dealing with economic substance requirements. So as I've mentioned, there are two new legislative pieces in the UAE which introduced, let's call it ESR 2.0. So we have Cabinet Resolution number 57 and then the Ministerial Decision number 100. It's worth noting that this legislation is effective as from the 1st of January 2019, which in practice means that it is applicable to financial years starting on or after the 1st of January 2019. Now, in practice, this has the effect that there's a certain retrospective element to ESR, where companies which are in scope needed to meet those requirements on the 1st of January 2019, even though they were only announced at a later point in time in March 2019 and then were amended in August 2020 again. This can pose a challenge, let's say, and let me illustrate this perhaps with a very simple example. So one of the requirements to meet the economic substance test is that you are directed and managed in the UAE. Now, in order to meet that requirement, licensees need to maintain meeting minutes that are signed by directors which are physically present in the UAE at the time when the decision which is taken is reflected in the meetings. Now, from our experience in practice, we noticed that only a small proportion of businesses met that requirement on the 1st of January 2019. So we would say that this is one of the first challenges that businesses will have to deal with in terms of assessing their ESR status and meeting those requirements. In the top right, we've also noted that the ESR are applicable to both mainland and free zone companies. At the very start, when ESR was introduced, there was a little bit of doubt around whether free zone companies would also be in scope, but at this point in time, there's no doubt about it. So free zones are definitely in scope of the economic substance requirements in the UAE. Now, when are you in scope of ESR? When you are a licensee that carries out a relevant activity, at that point in time, you will incur obligations under the economic substance regulations. There are 9 relevant activities that we've listed here on the slide. And the ones that we've highlighted in orange are the relevant activities that are most commonly associated with the financial sector. Now, does that mean if you are active in the financial sector and you don't carry out one of these activities, that you are 100% sure that you are outside the scope of ESR? Definitely not. It is possible, for example, that you carry out a headquarters business or a service center business, which we've highlighted here in white. This could, for example, be because as a company, you provide senior management functions or you are rendering services to a related company which is located outside of the UAE. Now, when we're assessing the relevant activities of a company, we need to take into account the substance over form principle. Now, what does that mean? It means that rather than merely looking to the activities that are listed on the trade license, we will have a look at the actual activity that is carried out by the business. So the first relevant activity for the financial sector is banking business. And it is simply defined as the business of accepting deposits in order to use those deposits to provide loans or similar facilities, making investments for the account and for the risk of the licensee. Now, what is remarkable about this definition is that it differs from the definition of financial activities in Federal Law number 14 on central bank and the organization of financial institutions and activities in the UAE, where we would have expected that the definition would be more similar to the one that is provided in that federal law, which dates back from the 80s. Now, on the top right, we've mentioned in respect of banking business that there is no duplicate reporting. What does that mean in practice? So with the new ESR legislation, the Ministry of Finance has provided guidance and has stated that certain relevant activities can be considered as a main activity in respect of another relevant activity, which is then considered as the ancillary relevant activity. Now, normally, when the licensee carries out more than one relevant activity, it needs to meet the substance requirement in respect of each separate activity and also needs to meet the reporting requirements for each activity. However, when you have a main activity and an ancillary activity, you can disregard the latter and just report in respect of the main activity. So for example, if you are a banking business, and in addition to that, something which is very common is that you provide services to related parties outside UAE. In such a case, you would also be considered a service center business, but the ESR guidance states that in such a case, you will only report in respect of the banking activity. Now, as a banking business, you will generally be licensed as a commercial bank, and it will be under one of the 3 regulatory authorities that Jack also mentioned in his part of the presentation. So for mainland companies, we have the UAE Central Bank. For companies that are licensed in the DIFC, we have the DFSA, and companies that are licensed in the ADGM, they will fall under the FSRA authority. With this slide, I wanted to illustrate that there are certain situations in which you can be an actor in the financial sector and still not be considered a banking business. So you're not considered as carrying out a relevant activity. So what we have here, the example on the slide, is a UK bank which provide loans and mortgages to UK lenders. And when those loans start defaulting, they will sell the loans to an ADGM entity in the UAE. So the ADGM entity will purchase the loan portfolio, and then in the next step, the ADGM entity outsources the collection of those loans to a servicing agent in the UK. In exchange for that service, the servicing agent will receive a commission which is paid by the ADGM entity. Now, although it's clear that the ADGM entity is active in the financial sector, it is not carrying out a banking business for ESR purpose. And another thing to note perhaps is also that when you look at the activity that is being carried out by the ADGM entity, it's worth noting that it is a highly mobile activity, and this is specifically the kind of activity that is targeted by ESR, and therefore it's strange that this is not captured under one of the definitions of the relevant entities. In this slide, I wanted to talk a little bit about branches. So the new ESR, they provide a lot of guidance around the treatment of branches specifically. In this example, I have focused on local branches in the UAE. So UAE branches of a UAE head office. Now, what does the ESR regulations state in respect of local branches? First of all, they say that branches are to be considered as an extension of the head office, and they are not considered to have a separate legal personality. Now, what does that mean in terms of ESR reporting? The UAE head office will only file one single report, one single notification in respect of both itself and all of its local branches. So this is one clarification that the new ESR brought along. There are 2 other possibilities in respect of branches. So you also have the situation where you have a UAE head office and a foreign branch. In that respect, the ESR has clarified that you can basically disregard the foreign branch to the extent that its income is taxed in the other jurisdiction. A second situation may occur where you have a UAE branch of a foreign entity, and this is a concept that Thomas will talk more about, because in such a situation, the branch of the foreign company can qualify as a so-called exempt licensee. What is not considered a banking business for ESR purposes? When a licensee which is part of a banking group only provides advisory or arranging services to other members of the banking group. What you have to watch out for here is, although not considered a banking business, it could still qualify as a service center as you are rendering services to a related party outside of the UAE. The exchange of currency, remitting money, is also not considered as part of a banking business, acting as a financial intermediary in the sale or purchase of stocks, also outside the scope of a banking business. Then we're moving on to insurance businesses, which is defined as the accepting of risks, contracts of insurance, both life and non-life insurance, reinsurance, and also captive insurance arrangements, which we will talk about more about further in the presentation. What is not considered an insurance business, the activities of brokers, agents, and other business providing insurance-related services, which do not involve the assumption of risk in exchange for the payment of premiums. Now, on this slide, I wanted to talk a bit more about captive insurance. A captive insurance company is basically a group company which insures the risk of a related group entity. So as you can see here on the slide, we have the operational entity in India and a captive insurance company in the UAE. What is characteristic of a captive insurance company is that they are both owned by the same shareholders. So the operational entity will pay a premium to the insurance company, and then in exchange for that premium, the captive insurance company will provide risk coverage. So even though there is no insurance of third-party risks, the UAE company will still be considered as an insurance business for ESR purposes. I've also noted here on the top right that there is no duplicate reporting in respect of, sorry, let me go back to the previous slide. So there is no duplicate reporting in respect of captive insurance arrangements. And this slide immediately shows why. Because when the captive insurance company is considered an insurance business, there's also a very high chance that it will be considered as a service center by virtue of rendering services to a related party outside the UAE, which is the case at hand here. So that's why there's that exception for duplicate reporting, but it only applies to captive insurance companies, so not any other types of insurance. Now we're moving on to investment management. Investment fund management is defined as the provision of discretionary investment management services in relation to investment funds. What is outside the scope of the investment fund management business, the mere administrative or custodian services, investment funds themselves are also outside the scope of the investment fund management businesses, unless they are a self-managed fund, so situation where the fund is basically providing management services to itself. Then the lease finance business is defined as the provision or offering of credit or financing in exchange for consideration, including intra-group financing, such as the provision of intercompany loans. What is not considered a lease finance business, investing in bonds, securities, debt instruments traded on the stock exchange. Again, here there is an exception for duplicate reporting in respect, for example, of a headquarters business or a service center. If such a business also carries out a lease finance business, then they will not have to report in respect of the ancillary service. Now, I wanted to have an in-depth look at the financing arrangements, such as treasury or cash pooling situations, which also fall under the definition of a lease finance business. Now, cash pooling is basically the offsetting of the cash positions of the constituent entities of a group in order to obtain certain financial benefits, reduction of fees, reduction of interest on debit positions. And this mechanism of cash pooling, when done in the UAE, will be captured by the concept of a lease finance business, because the mechanism behind cash pooling is the provision of intercompany loans, where you again have that credit factor which draws you into the scope of a lease finance business. So this concludes the first part of the ESR basics. I will now give the floor to Thomas, who will talk a little bit more about the concept of exempt licensees.
Thanks a lot to Nils. We have certain limitations in our software in respect to the amount of presenters that we can have at the same time, so that's why we had to do a little switch there. So Nils covered the regulated businesses under ESR. where it's important to remind yourselves that even if a business is not regulated, it could fall under distribution and service center business, or even if it's not using effectively the activity for which it is licensed, it could fall under it. Now, the big difference between this year's ESR law and last year's ESR law, which we never had to apply, is that we have 5 categories of exempt licensees. You see them in front of you, and I'll be covering 2 of those. The ones in orange, the entity tax resident outside of the UAE, and the branch of a foreign entity. So UAE branch of a foreign entity whose income is subject to tax outside of the UAE. As Nils already mentioned, for the investment funds, the investment fund itself and the opcos, the targets, they are outside of the scope of, they are an exempt licensee, which means they only have to make a notification, and they do not have to meet the economic substance test. And that's the common trait in these 5 categories, which is all of these 5, they need to file a notification, but they do not have to meet the economic substance test. The obvious thing that we're going to talk about as well is how to meet that threshold of evidence to prove that you are effectively an exempt licensee. And the first category to talk about is the one where an entity in the UAE is tax resident in a jurisdiction other than the UAE. And it's interesting to reread the legislation, because the legislation actually mixes up 2 things. On the one hand, tax residency, and on the other hand, the income being subject to tax. And those things might not be the same thing. Philosophy, though, in terms of tax resident outside of the UAE, is you're not setting up your structure in the UAE for tax optimization purposes. Your income of the UAE is effectively completely subject to tax in the other jurisdiction. And it's interesting to note that the law says all income from the relevant activity in the UAE, whereas the guidance is a bit softer and just says that the income from the relevant activity needs to be subject to tax outside. Now, it's opening pretty much Pandora's box here, because what constitutes an entity who is tax resident outside of the UAE is largely dependent on domestic criteria in that other country, and which need to be read together with the double tax treaties as well. Result of the matter is that this criterion is very much fact-driven and dependent on a tax regime in the other jurisdiction, as we will see in a bit. The common issues with the 2 exemptions that we want to highlight is, for example, if you want to identify the income of the UAE entity in the return of the entity which is tax resident outside, so same legal entity, but the income of the entity is subject to tax abroad, is how to identify this. Tax returns are not the same format globally all around the world, and exemptions are not the same either. An entity might be tax resident in multiple countries as well, and you might not be able to simply identify and say, this is the UAE income. We're effectively, our company, which is a UAE company, is a tax resident in, for example, Egypt, and you can fully identify the income of the UAE entity in the Egyptian potentially a branch corporate income tax return, or a permanent establishment income tax return. A second element that we've already seen in practice as well is you need to be able to convince the tax authority to provide a certification. And a certification will always be granted from the viewpoint of the foreign tax authority. So we've seen examples for Swiss companies where the Swiss tax authority, which is not the federal tax authority in Switzerland, but the canton tax authority, says, we consider that the entity established in our canton is taxable on its worldwide income. Now, is that phrase sufficient to convince the regulatory authority and eventually the FTA that the branch exemption can be claimed, yes or no? That's a big question for which the guidance doesn't give us any answer. In addition to that, luckily the Swiss guys, they were pretty lenient with us, and so have been some of our American clients as well, where they asked the IRS for statements. But you can end up maybe with contacting the French tax authorities, and they might be a bit less willing to not use their own language and use Shakespeare's language instead of Moliere's. What examples could you have? For example, you could have a UAE company with a place of effective management not in the UAE. That would make you tax resident in another jurisdiction, not necessarily subject to tax for all income in that other jurisdiction, but you would be subject to tax in the other jurisdiction. An important clarification as well in that respect is that when you're paying withholding taxes abroad, that does not mean that you're subject to tax in that other jurisdiction. The most prevalent or most used exemption that we've seen so far and that we've done the most work on is the UAE branch of a foreign entity. So imagine a German company has set up a UAE branch and conducts a relevant activity in the UAE. That branch can be exempt from having to meet the economic substance test, provided that its UAE income is subject to tax in the jurisdiction of the foreign head office. Especially when dealing with European countries that have so-called CFC rules, controlled foreign corporation rules, which require when the entity is controlled to report the income of the branch in the corporate income tax return of the parent. Those are situations which could present themselves. But again, we've got a number of practical issues simply to prove it. And I would add, in addition to that, but it goes a bit outside of the scope of today's presentation, is that we need to deal with the regulatory authority that needs to review the submission and eventually forward it to the Federal Tax Authority. And the Federal Tax Authority in the UAE is going to have to develop a policy around what is green light in terms of the exemption, what is a red light, and that might take a very long time. That's time, unfortunately, that we do not have, because the exemption, the claim for the exemption needs to be filed in December. If they review the file much later and come to the conclusion that no exemption can be claimed, then we need to work back and go ahead and file the economic substance tax return, where Nils has said before already, there's a number of issues with meeting those criteria. To give you a quick example of what that subject to tax criterion would mean is that if I've got a UAE branch of a foreign entity and the foreign entity is in Germany and the branch income is reported in Germany and subject to corporate income tax in Germany, then you would be an exempt licensee. However, if the parent is in Caymans, given the fact that there's no CIT in Caymans, then the UAE branch of the Caymans entity would not be able to claim the exemption for meeting the economic substance test. And maybe a bit of a question mark, if the parent is in Singapore, Singapore only taxes activities on its own territory. So the UAE income would effectively not be subject to tax in Singapore. And there's a bit of a contradiction there between what the law says and, again, what the guidance says. Luckily, the guidance is a bit broader, but any good lawyer will say that eventually it's the law which prevails and not the guidance. Just to go through a few challenges before I hand over to Nico. One was already mentioned by Nils, which is the directed and managed criterion in the UAE. We've obviously got the situations of the letter boxes and the PO boxes where it is obvious that the directed and managed criterion is not met. But we've got a whole host of scenarios and situations where it's a bit more tricky to do. For example, one live situation is we work for a big German group, and effectively all strategic decisions, the big principles are taken in Germany, and then there's a certain amount of autonomy for local management in the UAE. Does that mean that the local management in the UAE is still taking strategic decisions or not, or is it merely executing? For us, it's somewhere in the middle. We've obviously got also the important condition that board meeting minutes have to be signed and kept in the UAE, and it's very hard to jump into a time machine and retroactively comply with board meetings which were not held in the UAE. As a final point on the directed and managed criterion as well, some free zones might have softer regulatory requirements compared to the ESR. It might not be necessary to have board meetings, whereas for ESR purposes, it is. In terms of the outsourcing criterion, you can outsource your core income generating activities. The main challenge that we've seen so far is that obviously outsourcing is allowed, but you need to be able to demonstrate the supervision and control. And these contracts, they need to have a bit of additional language in order for you as the outsourcer to be able to show how much supervision that you effectively doing over the company that you outsource your activities to. As a final note, before jumping into Nico's very exciting CRS presentation, is some of the issues that we've seen so far in trying to identify what financials to report is when determining when using the group criterion. We had cases where we had a UAE company and a European company which were not held by the same parent, but were held by the same shareholders. So this, in our view, did not constitute a group, but it's a bit of a gap in the whole legislation, because effectively, again, it's a mobile activity that you could put in the UAE. The other situations that we had were important participations which were recorded but do not have to be consolidated. So if they do not have to be consolidated, they're not considered as part of the group, and therefore when you provide them with the service, it's not considered as a foreign connected person. Another issue is for financial statements which are not in dirhams or dollars. The guidance refers to a spot rate for receiving, paying, or accruing income, whereas the financial statements looking at the balance sheet and the profit and loss at the end of the year, they might not use a spot rate. They might just use one single rate for the whole conversion. So there's a bit of a difference there. Let's see how closely the regulatory authorities and the National Assessing Authority, i.e. the FTA, will look at that. As a final point, we had a federal UBO law recently, which overhauled a previous one. In the reporting for ESR purposes, you need to identify who the UBO is, and that only refers to a private person who's holding directly or indirectly an entity. However, in the federal UBO law, we have a number of fallback categories, such as, for example, senior management. Now, even though you have to identify which type of UBO needs to be reported in the ESR report, the ESR report nor guidance makes any reference to that federal UBO law. So the question is really, do we need to continue following the federal law in respect to identifying the ultimate beneficial owner or not? In addition to that, what I would also add, and this is very important, we've got an exemption to identify the UBO for listed companies, and there's no mention of that for ESR purposes, which does constitute an important practical difficulty. I hope I didn't take too much of your time, Nico, but over to you right now for CRS.
Thank you, Thomas, for this introduction. So I'm Nico van Bockstal. I'm director with Vistra, and I'm responsible for governance, risk, and compliance services. Just to inform the audience, what we forgot to do in the beginning, at the end of this webinar, there will be a test on your knowledge of acronyms. So I'm not going to add too many other acronyms to this. I just want to highlight a few recent changes that happened with Common Reporting Standards, CRS. Yeah? Just to let you know where you can find the CRS information. You can find that on the UAE on the website of the Ministry of Finance. You can find the same on ADGM website, the IMC websites, and you see there that indeed the year that you find in the titles of the regulations has changed in 2020. So we had earlier this year some amendments to existing legislation, and merely what it was all about was the introduction of two new penalties that I would like to cover in further detail during this session. So the first one that we have is about the opening of a new account. So if a reporting financial institution, so that is a financial institution or another investment entity that is subject to CRS reporting, if that entity opens a new account for a client, and if that is done without obtaining a valid self-certification, or in addition, that entity fails to validate a self-certification, then this can result in a fine of 1,000 dirhams for that reporting financial institution per case, per client file where such a self-certification is missing. So how does it work? Well, it is about the regulatory authority will notify the reporting financial institution of the violation and also the fact that there is a fine, the fine of 1,000 dirhams to be paid within 30 days, and then the reporting financial institution has 30 days to pay that fine. Yeah? Now, question is from, okay, how is the regulatory authority, will the regulatory authority become aware of such an events and such breaches? Of course, that can be done during on-site inspections. So if you look at the IFC register of companies in the DGM, the FSRA, they can conduct on-site inspections, and if they find during their inspections that such documents, self-certifications are missing in client files, then they can start a process of issuing that fine of 1,000 dirham. Of course, what we also have for regulated entities, they have a compliance function that is responsible for monitoring and testing the compliance of that entity with rules and regulations, including common reporting standards. So if the compliance function would detect that there is somewhere a gap or there is a breach with the CRS requirements, then that compliance entity, the regulated entity or the reporting financial institution will have to report that to the financial services regulator, who can then also inform the other authority if there is a need for it. Yeah? So it's not only the regulatory authority that will find out, will have to find out certain things. It will also be that mechanism of the traditional breach reporting that will work and that will bring this information to the attention of the regulator. Then, before we move to the second group penalty, I just wanted to remind on something that is already in the current CRS regulations. Yeah? That is that there is an obligation for the reporting financial institution, yeah, that it cannot rely on self-certification or documentary evidence that seems to be incorrect or unreliable. Yeah? So it's not that a reporting financial institution can blindly rely on whatever documents and information that is provided to it. Does it mean, on the other hand, that there is a duty to start active investigating every piece of information and documents that is presented to a financial institution? The current regulations are not prescribing this, and it's not as in so much detail mentioned. But of course, you have the reality that reporting financial institutions are sitting on a huge volume of quantity of information and documentary evidence that they have to collect to comply with all kind of other legislation like AML, conduct of business, suitability. So this is all kind of information that is already collected by financial institutions that they have in their hands. So they have a lot of background information that they can use or have to use to compare it with the self-certifications that is presented to it by account holders or their beneficial owners. Yeah? Now, how far all of this needs to go, that is still a question mark, and there you see certain trends and certain practices going on in the market. And the more these practices and trends are going on in the market, the more that this will also become somewhere the expectations from a regulator or from independent auditors. So there has been already some questions about, okay, utility bills as proof of address. Okay, doesn't reporting financial institution needs to verify whether the value of that property is in relation to the wealth of a certain individual? If somebody presents a utility bill as proof of residence, does it need to go that far that the financial institution needs to check where somebody is effectively living there, if it makes sense? So this is all not prescribed in the regulations, but there are certain trends and practices going on. The same is also about the difference between active and passive NFEs. Okay, it's all about checking into the company documents that are in possession of the reporting financial institution to see what is the purpose, what is the nature of a company structure. Is it active? Is it passive? And then deal with the consequences. Yeah? So then this brings me to the second penalty. Yeah? This is about submission of inaccurate or incorrect information. So this is a penalty that can apply to an account holder or a controlling person, beneficial owner. Yeah? And it's all about, okay, if an account holder submits a statement of personal information that includes inaccurate or incorrect information, details, or documents, then this can make that person liable to a fine of 20,000 dirham. So this is a high amount, which can apply to an account holder, not to the financial institution, but to the account holder. Of course, there is also somewhere an intent required. So it must have really been the intention of the account holder to provide inaccurate or incorrect information. Yeah? So how is the process going to work over there? There, the first line responsibility is with the reporting financial institution. So if a bank receives a document, self-certification, that it thinks, look, this doesn't make sense, this is not correct, this is presenting reality, misrepresenting reality. Okay, that is something that will need to be reported by the reporting financial institution to the regulatory authority within 30 days. Then this will be picked up by the regulatory authority, who will contact the account holder. And for that purpose, the reporting financial institution needs to provide the regulatory authority with the identification and the contact details of the account holder. So the regulatory authority will notify the account holder within 30 days of the amount of the penalty, up to 20,000 dirhams, and then the account holder will have 30 days time to pay the fine, the penalty. Yeah? Now, this is something new, something different. I've not seen that many occasions where a regulatory authority or a regulator can undertake action towards an account holder or a controlling person of an account holder, because normally the audience of a regulator of an authority is the reporting financial institution, not the account holder. So how this will work from a legal perspective and from an enforcement perspective, that I just want to place a question mark over here. But I'm sure that this is something that lawyers and tax advisors will have an opinion on it. But it's just a question mark that I want to place over here, how this can be and shall be enforced. Now, what this all means is that where until recently the regulators, certainly financial service regulators, that they did not have legislation like CRS and FATCA on their top priority list. It was under their radar, but it was not on the top of their radar. It is with this kind of legislation that this is expected to change, and that regulators will ask more questions to financial service providers and other relevant entities from how they comply with this kind of legislation. Yeah? So we expect that there will be a closer follow-up, that they will focus on it during on-site inspections, on-site reviews, perhaps even have thematic reviews on it. The first one was already conducted 2 weeks ago in EDGM, for instance, and that during on-site inspections that regulators will go actively into client files, not only to check whether those client files are okay from an AML perspective or from a conduct of business perspective, but also whether the self-certificates are correct, whether they make sense, if the regulator looks in the totality of the client file. So This exercise is expected to happen and is already going on. So we see that shift already going on. So that makes that reporting financial institutions will have to make sure that they have policies and procedures in place so that they can demonstrate how they have implemented and how they comply with CRS regulations. Yeah. This will need to be included also in the compliance monitoring and testing program of the compliance officer, whereby if breaches are identified, those breaches will be notified to the regulator so that fine penalty mechanism can start working. Okay, there will have to be included in internal and external compliance reporting, and of course, staff awareness will need to be created around this. So the CRS legislation existed already. It's just that we have an enhancement to it that probably will make that financial service providers will need to have a closer look in, okay, what kind of information that is provided to them. Yeah? If that is not happening, then this can result in penalties and fines. So I think we are moving from just filing and priority for filing, that we will now go more into to the quality, more attention, or more focus on the quality of filing as well. Thank you. So this is what I had to mention on corporate, on common reporting standards. So now I'm happy to pass on the word to Roberto.
Hello, good morning, everyone. Before we go with Roberto, we have a section on VAT. I'll try to run it quickly, being cautious of the time. So getting onto the financial services and the VAT impact on the financial services, just to quickly set the tone. So right now we already understand that whenever a supplier which is going to be a financial services provider who is based in the UAE, providing services to their clients, and the clients could either base in the UAE or they could also be outside the UAE. There is a special place of supply rule which is not applicable for the banks or for the financial institutions. Rather, the general place of supply rules apply, which is to say that wherever the service providers are located, that is going to be considered as the place of supply for determining the VAT treatment. So practically, you can see on your screen, we have put here two scenarios. On the left one, you can see the supplier is located in the UAE. The recipient is located outside the UAE, and the place of supply, which is the general place of supply, which is the UAE. If this is the scenario, the fixed fees will be zero rated, as well as the implicit margins, which is charged by the financial institutions, that is also going to be zero rated. If we go on to the second scenario, the supplier is based in the UAE, the recipient is also based in the UAE, and lastly, the place of supply is the general place, which is the UAE. In this scenario, the fixed fees will be standard rated, and the margin, that is the implicit margin, not the explicit one, that would be exempt. Now, the important change which is now happening is how do we learn the term or understand the term recipient, and second would be on the zero rating of application of the zero rating provisions. So firstly, there could be certain challenges in terms of how we identify who the actual recipient is. So on the next slide, you can see here on your screen, we have given you one example. So here, to start with, we have a UAE bank, which is providing certain money transfer services to a local company, let's say UCO, and UCO has to pay some money to his supplier, which is based in the UK. So UCO has to pay £1 million to ESCO. Now, in this trade, UCO goes to the UAE bank and requests the bank to remit GBP 1 million, and by collecting, AED equivalent of that currency. So the UAE bank is, of course, going to charge a transfer fee, and the UCO bank has an agreement in place with the bank that the transfer fee will be deducted from the money that is to be remitted to the company in UK. Now, in this scenario, although the money is being charged, or rather the fee is being charged by the bank from the UK-based supplier, but the agreement is in place with UCO, which is the local UAE company. So in this scenario, the recipient is UCO. And there are some guidance which is already available in place, and also we got it via private clarification. And the key factors to determine who the recipient is going to be the contractual recipient, the one with whom you have your contract with. There could be a third person who is making the payment of the fees or the services. However, the contractual recipient is going to be considered as the actual recipient of services. You can see the last point, which is also important here, that sometimes you have some interest or benefit. So there could be a third party who is benefiting from the services. However, that is also not the recipient of the services. It is still going to be the contractual recipient, which is the ultimate recipient of the services. Now, going forward, on the zero-rated export of services, so there has been a recent amendment, not so recent any longer. It was issued on the 4th of June and was available on the 15th of June. We are talking about Cabinet Decision number 46 of 2020, which kind of is an amendment to the erstwhile Cabinet Decision 52 of 2017, which was the executive regulations of the VAT law in the UAE. So in terms of zero rating provisions, so we understand that the general place of supply rules apply, and consequently on the financial services as well. In order to zero rate such services, you need to follow a strict set of rules. So what is the rule? Let us go together with the decision tree that you see on screen. So first determination point is the client a UAE resident? So when I am, let's say, a supplier of financial services, I first have to determine, is the client a UAE resident? If yes, then there is no question to zero rate. We just have to apply 5% on the fixed fees. Going forward, if the client is not a UAE resident, then we have to see whether the client receives any services in the UAE when these services were performed. If no, we go further and we find out, is this service connected to real estate? Not applicable, most likely for the banks. There could be certain services which are in relation to tangible or movable goods, again not applicable to financial services. And lastly, is there a third person who is receiving these services in the country, in the UAE, and who is not able to recover the input VAT which is being charged by the financial services? If we meet all these conditions, then only you can zero rate such financial services. Now, the key change which has been introduced by the executive regulations is the one that you see, which is highlighted here. The first one is how to determine who is the recipient, and secondly, whether he is resident in the UAE. So we have understood that how to identify the recipient, but you also have to see if that recipient is resident in the UAE. And the second one would be whether this client receives the services in the UAE. So how do we determine that? Those are the two key things that the amendment has introduced. So let us go on the first one, which is whether the client is resident in the UAE. Now there could be a scenario where the client has a place of residence in the UAE and also outside the UAE. So what is a place of residence? It could either be the place of establishment or it could be a fixed establishment. So wherever the client has multiple places of residence, one in the country, one outside, we will have to determine which one is most closely related to the services. So the one which is most closely related to the services, that one will be considered as the recipient entity. And based on that, we will have to apply the zero rating provisions. So how do we know which establishment is most closely related to the supply? To learn that, there is a separate clarification which was published by the FTA, which is VAT P019. In this clarification, it gives a standard checklist of 6 points. So what are these 6 points? It says that that establishment will be most closely related to the supply, which has actually signed the contract, which benefits from the supply. It also receives the invoice, it makes the payments, it provides further instructions, and lastly, the services that are being used by this establishment, it is for its business. So when you achieve all the 6 conditions mentioned here, you could be considered as that establishment which is most closely related to the supply. Once that is established, we have to see whether that establishment is in the UAE or outside the UAE. If in the UAE, then practically you cannot no longer apply the zero rate. And of course, if that establishment is outside the UAE, they will go on to achieve the next conditions of zero rating. Secondly, the key amendment which came into place was in relation to how do you determine the client receive the services in the UAE. Here there is a very small word which was been amended. It's just one word which was amended in Article 31(2). This word was or before, and now it is and this word is placed in between these two criteria, which is whether the client was physically present in the UAE for a period of a month or less, or supplies which are being made, the person who is receiving the supplies in the country is not connected with the supply. Earlier, the words were or in between these two criterions, and now it is and. So the effect of this is, is significant. Practically, if you see the table on your screen, you can see that there could be a short-term presence of less than a month, that the client representative is present in the UAE, but is not connected to the supply. In that scenario, before the amendment, it was outside the state, that is outside the UAE. Even after the amendment, it is outside the UAE. If there is a long-term presence of more than a month and the person who is present in the UAE is not connected to the supply, before the change, it was outside, but after the change, it is now within the UAE. So you cannot apply the zero rate. Similarly, if you see the last scenario where there is a long-term presence and the person is effectively connected to the supply, again, it is inside the state. And lastly, if there is a short-term presence, but the person is effectively connected. So even if you have one meeting in the UAE or practically to receive the services, there is an employee of your client present in the UAE, even though it is for a short-term period of less than a month, you will still not be able to zero rate that portion of your services. Again, needless to mention that there could be continuous supply of services. And whenever there is going to be continuous supply of services, again, you have to evaluate whether the client is physically present in the UAE at the commencement, during the performance, and at the end of the services. So you have to take the entire period when you are rendering those services. So this change will have significant implications. Taking it further, there are still some questions which are open and which is not addressed by the public clarification. And a few of those questions are on your screen. Important ones is 5% should be applicable on just the part which is in relation to the services rendered in the UAE, or should we apply it straightforward on the entire services being rendered. So for example, you could have you are a bank operating in DIFC. You meet your client in order to sign the contracts and to ensure that he understands the engagement. So you have a meeting with them in the UAE. Whether we can just apply 5% for this meeting portion, or should we go ahead and apply 5% on entire fixed fee which has been charged for the whole services. So that is question number one. The second question is regarding the duration of the presence. Now the law, the regulation, it simply says that it should be short-term presence which is less than a month. But how do we determine what is a month? Should we say it is 4 consecutive weeks? Or should we just count in number of days being 30 or 31? So it is still open. There is no clarification on that. The next one is there could be scenarios where as a financial institution you would not know whether your client employees are sitting in the UAE or any third person is present in the UAE for a period of more than a month. In such situations, will a self-declaration by the recipient work in favor of the financial institutions? We do not know, but it could be one of the things to hedge the risk. And lastly, if a third person, there is an authorized representative of the client is present in the UAE, maybe a regular employee, but he's not connected with the supply, the presence is more than a month, it is still going to interfere with application of the zero rate. So there is no further clarification on how do we determine which employee is going to whether receive the services or present in the country. So there are some gray areas here, and if you take a conservative approach for all the 4 questions written here, most likely in a lot of scenarios you would still end up not applying the zero rate. You would end up going ahead with the 5% on fixed fees. Now, there are some other consequences as well, just to quickly run through them. So once you are not considered as outside the UAE, practically all your zero rated supplies, that is your fixed fees, will now become standard rated, and the margin base, that is the implicit margin, which would have been zero rated, will now be exempt. So the moment this becomes exempt, your input recovery ratio is going to get worsened further, right? Your ratios will go down, and frankly, the foreign clients who may not have any presence in the country may or may not be eligible to claim the VAT refund, depending on the reciprocity arrangements of the recipient country with UAE. So these are some open areas. There is one small nuance as well from an input tax recovery point of view. So there is one another article, which is Article 52.2, which is regarding the input tax recovery. And this article again, repeats the same definition of outside the scope, outside the state, which is defined in Article 31.2. But this particular article is not being amended, in line with Article 31.2. Practically, this would mean that either we have to read this article similar to Article 31.2, or this could lead to some further gray areas. We're not going further into that, but that is just something that one needs to take care of. And lastly, there could be certain supplies which the banks or the financial institutions they make, which is outside the UAE, but they could be exempt if they were made in the country. So for example, you could have a collateral as a physical asset which is being sold outside the UAE. Let's say it's a residential asset, but when the same asset would have been sold in the country, it would have been exempt. So how do we treat this outside the scope supply in the UAE from an input tax recovery point of view? So whether you will have to consider this as an exempt, that is in line with exempt, and consequently your input tax ratios will get hammered further. So these are some areas that still needs more fact finding and more research to be done, and then come to a final conclusion. So that's it from the VAT point of view. I would like to hand over to Roberto now to throw his insights on the CIT part. Thank you so much.
So good morning, everyone. I think I have 5 to 10 minutes left, so I will try to be very fast in my speech. I think that the background of my speech is some way overlapping with one already addressed by Nils and Thomas about the economic substance regulation, because in common we have that the international guidance coming from the OECD mainly are going to shape the UAE approach. But what is the main topic I'm going to talk about is the international double taxation for direct tax purposes of the entities involved in the financial sector, that at least in the perspective of the UAE shall be divided in two main groups. On the one side, banks, on the other side, all the other financial entities. So while banks, of course, shall be considered as entities that could be double taxed, since in the UAE, namely in Abu Dhabi, Dubai, and Sharjah, we have income tax applying to branches of foreign banks. So for the other financial entities, this double taxation could not arise. Of course, bearing in mind that the UAE applies a territorial system of taxation, so all the income arising from sources outside the UAE would not count. The three main points I would like to say some words upon, and that shall be reconsidered in the light of the new approaches from the OECD mainly, but also from the EU, European Union, are the subjective and objective element of double tax treaties, so the treaty entitlement that the taxes treaties apply to, the allocative rules, and paying attention to the hybrid financial instruments, and then some issues concerning double taxation and double non-taxation. When it comes for the so-called treaty entitlement, I think that any one of us has in mind that double tax treaty applies only to persons who are resident in either or both the contracting state. The issue of residence is quite relevant when it comes to the UAE, because a person is resident to the extent is liable to tax. So for quite a long time, we know that we had the problem that person resident in the UAE were not effectively taxed. Now we all know that resident in the UAE are considered to be resident for tax purposes, although not being taxed. This is a perception also from the other countries. So the other countries, say Sweden, Italy, Greece, and so on, will be applying the treaty also if the person is not taxed in the UAE. What is the let's say the relevant element for the entities in the financial sector? Entities in the financial sector in many cases are exempted from taxes in their country of residence. So they are resident, they are in principle liable to tax, but nevertheless they are exempted. What is the UAE approach in this respect? The UAE approach is that of considering that since the financial sector is quite relevant in many UAE treaties, such entities, and mainly the state-owned entities, are explicitly considered to be as resident for tax purposes. This is the case, for instance, in the treaty with Saudi Arabia, which is one of the latest one entered into by the UAE. So these entities are already deemed to be resident for tax purposes. But those entities are also considered for the purposes of the allocative rules. So we have a set of rules in many UAE treaties dealing explicitly with entities in the financial sector whose main features is to be participated by the state. So let's say sovereign wealth fund, many answers already in the treaties for their treatment when it comes to the application of double tax treaties. Important to bear in mind that those rules are not only affecting the residents for tax purposes, but in many cases also the application of the selected allocative rules. So, for instance, we have rules considering the taxation of capital gains that explicitly applies to governmental institutions, to state-owned entities, to state wholly owned entities, and so forth. Here you see a question mark concerning the state-owned banks, because if we have a look at the commentary to the OECD model, we could have the idea that only the, let's say, wholly owned banks, so the central banks, can claim for the application of the treaty as a person who is resident. But nevertheless, there is grounding to consider that also such banks that are not wholly owned by the state could claim the treaty benefit. And in some selected treaties signed by the UAE, this is explicitly mentioned, for instance, in the treaty with China. Then another topic that I shall address very fastly is the one of taxes the treaty applies to, because double tax treaty applies in general terms to taxes on income, capital, elements of income and capital. But nevertheless, there are some sort of levies whose features are not clear-cut, such as turnover taxes that in some countries apply in the financial sector. And this issue is not really clear in the international environment, but nevertheless, many countries are going to address in very details, since in the last 5 years, we have seen the growing importance of turnover taxes for the issue of the digital economy. So in many countries, we see that we have answers for investments that are going to be taxed by way of turnover taxes, and therefore for the application of the double tax treaty thereon. I will move very fast to the next topic, which is much more interesting, I wonder, than the first two topics, which is taxation of financial instruments. I think that the speech of Jack already laid some questions that some of you could have in mind in approaching the double tax treaty application to hybrid financial instruments. We have specific legislation in the UAE defining what a financial product is, what is a structured product, if securities, commodities are in or out, what in the field of taxation, of international taxation. All those issues shall be fitted within mainly in two rules, which are Article 10 or Article 11, dealing with dividend or interest. We know that these two articles have common features that are both applying in the case the person who is receiving the item of income is the beneficial owner of such income, and in such case, both articles will be applying a lower withholding tax in the state of source. meaning the state from which the payment comes. What is important to say is that dividing these two allocative rules is important because the double tax treaty provide for different withholding tax in the state of source according to the qualification of the item of income. So whatever the investment comes from the UAE in the other country, in the country of source, so let's say Spain or Sweden, it will be important bearing in mind that the qualification of the product and therefore the qualification of the item of income will be key in fitting the item of income within Article 10 or 11 and gaining the different treaty benefit. That could be, for instance, the application of the withholding tax of 5% on dividend or no application of the withholding tax on interest. That would be, for instance, the case for UAE investment in Saudi Arabia. Then it is important to bear in mind also that taxation of financial elements creates for tax planning opportunities that I have very few time to say that, but I think that any one of us knows that those financial products can lead to double non-taxation or non-taxation and non-inclusion because financial product could be deductible for the payer and taxable on the person who is receiving, or non-deductible, non-taxable. The latter scenario would be in the vast majority of cases for dividend, while deductibility and taxation would be for interest. So if we have a hybrid instrument, there could be cases in which in a cross-border environment, the same one item of income is deemed to be an interest and therefore deductible in one country, but a dividend in the other country and therefore not taxable. What is important to bear in mind for the financial sector activities in the UAE, that this scenario in which we have under taxation effect addressed by the OECD, have in mind cases in which we have a mismatch. So the same one financial product is deemed to be loan on the one side and equity on the other side, and not the cases in which the same item of income is deemed to be a loan on the one side and is not taxed on the other side, since a territorial system of taxation applies, as in the UAE, or since the entity that is receiving is exempt as a sovereign wealth fund. So we have to bear in mind that the guidance from the OECD have a limited effect, and mainly when it comes to the UAE, such under taxation effect can be considered absolutely in line with the OECD approach. I will move very fast to my last slide because my 10 minutes wonder are going to elapse. But before going to the last slide, I want to underline that in the international environment, we have different approaches concerning Islamic finance, and in some cases, many of us believe that double tax treaty cannot apply Article 11 dealing with interest because of the prohibition of interest-bearing loans, so the prohibition of riba in Sharia law. Nevertheless, in some UAE treaties, this problem does not arise at all because we have a provision dealing with I just go back to the slide with the income from money lent, so not quoting interest. And in some of those treaties, the other country is a country that adopted regulation about Islamic finance, such as Ireland. Go to the last slide and just stressing that we know that international double tax treaty aim at eliminating international double taxation, but in some cases, of course, they can allow to obtain an under taxation effect. So what are the main issues still arising nowadays? We could have still some mismatches that could not be considered by the relevant double tax treaty, while in some cases the double tax treaty provides for switching from the exemption to the credit method when we have such under taxation effect. Mainly the German treaties provides some rules. And we also have to bear in mind that some rules, such as the one that Thomas was quoting, the control foreign company rules, shall be coped with the double tax treaties. So we have Meanwhile, the application of the treaty and the application of domestic anti-avoidance rule. The application of domestic anti-avoidance rule is, for instance, still applicable in Saudi Arabia in the application of the treaty with the UAE, explicitly stated. The last topic is a topic on which probably we could spend hours or just 1 second. And my second, because I have just a couple of seconds on it, is that the tax treatment of tokens, and specifically speaking with crypto tokens as cryptocurrencies, is one of the topics in which all around the globe we have more questions than answers. But nevertheless, in some countries, we have already some answers. And we have some answers on 2 issues mainly: who can claim the treaty benefit, so who can apply the treaty and gain the treaty benefit, and second, what is the item of income, and therefore the allocative rules to be applied for such tokens. I want to stress, and then my speech is over, that in the EU we have a proposal about the regulation of tokens and payment tokens that was delivered in its first draft 15 days ago, at the end of October, and then probably in a very short time we will have, at least for UAE investors or for foreign investors in the EU, an overall outline, an overall context in which foreign investors and therefore UAE investors can have, let's say, appropriate answer for their investment, also for tax purposes. And that's all for my speech. I wonder I'm inside my 10 minutes.
Thank you very much, Roberto. We open the floor right now to questions from everyone. So Lovely has enabled the chat right now. Thank you for to all of yourselves to attending, making yourselves available, and sticking it out for sometimes technical topics for the financial sector, covering tax and regulatory topics. You can see that there's already some questions being put in there. So I think Pierre is asking in respect to a UAE branch of a foreign entity, category 4. Could you please? So definitely a branch and a head office would be considered as a foreign connected person. Subsequently, in respect of the revenue that you receive, it depends a bit. Is it revenue or is it just funding, a grant? But if you're providing a service from branch to head office, you would be inside the scope of ESR. At least in my view, would consider you as a service center business. Ambreen has a question for Roberto in terms of insurance, why it is excluded from benefits of treaties such as with Egypt and KSA.
So I don't know exactly if you are referring to the article dealing with the residents, so the person is outside the scope of this selected treaty. But in general terms, we have few rules dealing explicitly with insurance. One is dealing with the application, the wider application of the permanent establishment rule. In some other cases, we have not narrowing but widening the personal scope of treaties. So also insurance companies that are, for instance, exempt in their own country or participated by the state, they can trade it, they can gain the treaty benefit, although not being liable to tax. If you just copy paste the article and the number of the article, I will answer explicitly about this one, or I just can check by myself the treaty and understanding what are you referring to. If you're referring to the treaty entitlement in itself or a specific rule, let's say dividend or interest or capital gains that I did not address. Okay, so I can wait for the explicit rule she's referring to. I don't really know if it's about the personal scope, so the insurance entity cannot claim at all treaty benefit. I don't think so. Or if it's about 5.6 is probably about permanent establishment. So Article 5 fits to the OECD model, and Article 5 and Article 29.5 probably should be about something like non-discrimination or the procedural rules. So in very short term, we have to consider that while the UN model deals explicitly with insurance entities in double tax treaties, the OECD model for quite a long time did not. And for insurance entities, we have a problem. We have an issue that they can carry out a very extensive activity in the state of source, but nevertheless not arising IPE. So we have different answer according to the approach that the two countries decided to have in that respect. If we have not an answer, we will go back to the OECD or the UN model. If we have an answer, then we will be applying the rule that two countries decided to apply. So that rule is explicitly devoted to the permanent establishment. I see the, I go back to the answer and just to see.
There's also a question from Bianca on, with respect to, there's a few questions in there. I think that one is indeed, yeah, for local branches of foreign entities, the previously MOF and currently we don't know what the policy will be of the FTA in terms of issuance of tax residency certificates, because it's guidance, it's very limited guidance, doesn't cover this, so we need to wait a bit for that. But we know that for MOF indeed that was an issue. In terms of being able to use the double tax treaty between the UAE and Switzerland, what you'll basically need to consider is on the Swiss side what the interpretation is of the subject to tax criterion. I'm not sure if you also have a branch in Saudi, and that's why you're referring to Saudi. I don't know, Roberto, if you want to step in on this one as well.
Yeah, I see that there is a PE in Switzerland. A PE is not a resident for tax purposes. This is the basic outline. So whatever is the entity in one country, let's say in Russia, having a PE in Switzerland, that PE is not a resident, so it cannot claim the treaty benefit as a resident. It could try to claim the treaty benefit throughout the non-discrimination rule for permanent establishment, but Article 4 applies to a person who is a resident, and a permanent establishment is not. We have different cases if the entity that is resident in one country, so let's say an LLC in Switzerland or an Aktiengesellschaft in Switzerland, is
Roberto, it's parent entity apparently. So she was using the abbreviation for permanent establishment, but she means parent entity.
Okay. If it's an entity that is a resident, okay. Sorry, I thought permanent establishment. If it's a parent entity, so an entity that is incorporated in that country and in principle liable to tax on the overall income, the fact that it's not taxed on the foreign source income does not waive, in general terms, the liability to tax. Of course, we have to go on the other side. We have to see the other side of the coin. We saw the Arabian approach. If they have a certificate of residence, because the Switzerland Tax Authority issued the certificate of residence, that it should be enough for the Saudi Arabian entity, for the Saudi Arabian Authority. We have many cases in which a company who is resident in one country and should be in principle liable to tax on the overall income is taxed only on the income that is arising in that country. This could be due to a territorial system of taxation, could be due to a branch exemption regime. In Italy, for instance, we have something like this. In principle, the OECD model says that a person is liable to tax when he's taxed on the overall income, is liable to tax on the overall income and not on the income sourced in that country, but it refers to the non-resident. So it's not our case. So if the underlying question is, what does it mean, Article 4, when it says that the person is not liable to tax when he's taxed only on the income sourced in that country, that part of the article refers to non-resident. So my answer is, in principle, should try to apply the treaty between Switzerland and Saudi Arabia.
Okay. We've got a question from Farhan, which relates to the different types of legal entities and the inclusions and the exclusions. And I think the main question for him is what happens if an entity changes its legal form. It's not very common for entities in the UAE to change legal form. to go from a certain type of entity which would be in scope and go into another one. What you would have rather is, if the activity is shifted, that you see liquidation of the company that you're shifting the activity from. And in the guidance, it's been very clear that even entities which are under liquidation, they still need to meet the economic substance tests. For Nisha, yes, indeed we'll have another session, and I forgot to mention that in the beginning of our presentation. We will have very soon, probably in 2 weeks, a session dedicated to ESR, which will be broader than just financial services, where we will run through the template and how to fill out every single box of the ESR notification and report. I'll just wait for Rose and Bianca to finalize their questions. In the meantime, let me already just say as well that Jack has sent me a message that unfortunately he had to hop off to another call, and to already thank Nico and Roberto as well for attending, as well as my two co-speakers, Nils and Nirav. Just to take the last question from Rose. According to our sources, and also according to the guidance already, they've said that first week of December should be the moment at which the Ministry of Finance will open up the portal for the resubmission of the notification, and then the first economic substance reports will have to be filed by the end of December. So it's going to be a bit of a short rush in December, but okay, we'll have to deal with it. Okay, I'll let Bianca finalize her phrase. Okay, so. Bianca, yeah, on any services which relate to tangible goods, movable personal assets in the UAE, those services, they cannot be so-called exported. They cannot be subject to zero rates. Yeah, so it does relate to tangible goods. We use tangible goods and movable personal assets interchangeably. All right, conscious of the timing, apologies for going over time around 15 minutes. Very exciting topics which would potentially merit a much longer webinar, but we try to package everything into one single one. Thank you very much for attending. Thank you for your patience. We hope to see you soon. We will send you a copy of the slides, as well as, if you want to, a copy of the recording, and we wish you an excellent day ahead. Thank you very much.